On May 16, 2025, Canada made a move that stunned Washington. Instead of sending its oil south to the U.S., it signed a $320 billion deal with China, redirecting energy straight to Asia. The oil kept flowing, but the alliances shifted. China didn't just buy fuel, it bought influence. And while America was busy pressuring allies, it lost one. Quietly and without warning, Canada changed the direction of global power. On May 16, 2025, Canada officially began shipping oil through the newly expanded Trans Mountain Pipeline. But instead of heading to the U.S., a large share was redirected to China. This sudden shift caught many off guard. For decades, the U.S. was Canada's biggest energy customer. But in a dramatic turn, China became the top buyer overnight. According to Reuters, Beijing locked in major crude shipments the moment the pipeline went live. These barrels were originally intended for American refineries on the West Coast. But after new U.S. tariffs and rising tensions, Canada looked for new buyers, and China was ready. In just the first 4 months of 2025, Chinese oil imports from Canada surged by 870%, while U.S. exports to China dropped sharply. What started as a pipeline to expand options has now become a fast track for Beijing's energy ambitions. Canada didn't just reroute oil, it gave China a powerful new foothold in North America's energy game. In February, President Trump announced a 10% tariff on Canadian energy imports, including oil and natural gas. This move was part of a broader strategy to pressure allies into adopting tougher trade stances against China. However, the tariff had unintended consequences. Canada, seeking to protect its economic interest, responded by redirecting its energy exports to other markets. China seized this opportunity, rapidly increasing its purchases of Canadian crude oil. In April 2025, for the first time, Canada exported more seaborne crude to China, 299,000 barrels per day, than to the U.S., 286,000 barrels per day. This shift was facilitated by the expansion of Canada's Trans Mountain Pipeline, which allowed for increased capacity to the Pacific Coast. The reorientation of trade flows underscores the complexities of international trade policies and their far-reaching impacts. Canada didn't just react to tariffs, it made a long-term strategic shift. The $34 billion Trans Mountain Pipeline wasn't only built to reduce U.S. dependence, but also to give Canada direct access to global buyers. And now, that access is paying off for China. The pipeline leads straight to British Columbia's Pacific ports, making it easier and cheaper to ship oil and gas across the ocean. Alongside this, Canada is preparing to launch a major LNG terminal in British Columbia by late 2025, set to export 14 million metric tons per year. According to S&P Global, China has already secured long-term deals from this facility. What's more, China isn't stopping at buying oil. It's also offering to co-invest in Canadian energy infrastructure. In May 2025, Chinese Foreign Minister Wang Yi visited Ottawa and publicly proposed building a long-term energy partnership with Canada. Canadian crude, once locked into pipelines heading south, is now part of China's broader energy playbook. This isn't just about new customers, it's about rewriting supply routes, and Canada is suddenly at the center of that map. China's rush to secure Canadian oil isn't just about buying more fuel, it's about reducing risk. With global sanctions tightening on Russian and Venezuelan oil, Beijing is looking for stable, reliable suppliers. Canada checks every box. A politically stable country, high-quality crude, and now direct port access through the Pacific. Chinese energy giants like Sinopec and CNOOC are already in talks to purchase stakes in Canadian oil projects and export terminals. There's also a logistics advantage. Oil from Canada's west coast reaches Chinese ports faster than shipments from the Middle East. That saves both time and cost. For China, this isn't just energy security, it's smart economics. It's also part of a bigger move. using trade deals to build stronger political ties. And by getting closer to Canada, China gains influence inside a key U.S. ally's economy without firing a single shot. While China and Canada move closer, the U.S. is feeling the pain. American oil exports to China dropped 68% in the first quarter of 2025. But it's not just oil. U.S. farmers are also in trouble. Soybean exports to China fell from 40% of China's imports to just 18%, while Brazil and Argentina now supply 74% of China's soybeans. This collapse triggered a chain reaction. Soybean prices dropped 17%, wheat fell 9%, and pork exports sank as China turned to European suppliers. The U.S. government pumped over $122 billion into farm aid, including $7.7 billion for soybean growers. But it hasn't been enough. The American Farm Bureau reports farm bankruptcies hit a 10-year high this year, with Iowa and Illinois suffering the most. What started as a tariff strategy is now a full-blown crisis across multiple U.S. industries. What's happening now is no longer a simple trade dispute. It's a deep shift in how global trade works. China isn't retaliating with loud moves. Instead, it's quietly replacing American suppliers across critical sectors. In energy, food, tech, and even raw materials, China is building new trade routes that leave the U.S. out of the picture. This isn't just about oil from Canada. It's about long-term contracts, stable partners, and reducing risk. China is moving away from sanctioned countries like Russia and Venezuela and finding replacements in places like Brazil, Argentina, and now Canada. And these replacements are locking in deals that stretch years into the future. The U.S. approach has been heavy on tariffs and trade pressure, but that strategy is starting to isolate Washington more than its rivals. China is offering something else: stable deals, joint investments, and quiet reliability. Countries looking for long-term growth are taking that offer. The result? A slow but powerful shift in the global balance. Instead of confrontation, we're seeing substitution. American companies and exports aren't being attacked. They're being replaced. Canada is now stuck between two global powers that are pulling in opposite directions. Economically, it's finding huge benefits in trading with China. Energy deals, LNG contracts, and infrastructure partnerships are giving Canada access to fast-growing Asian markets. But politically and militarily, Canada remains deeply tied to the United States and its Western allies. In April 2025, Canada imposed a 100% tariff on Chinese electric vehicles, signaling strong alignment with U.S. concerns about China's growing influence. At the same time, Canada is expanding its energy exports to China and signing major clean energy partnerships worth billions of dollars. These moves show a country trying to balance two priorities, economic growth and national security, without being forced to choose between them. But this balancing act comes with risks. As Canada strengthens trade with China, it also gives China more influence over key parts of its economy, especially energy, ports, and shipping infrastructure. If tensions rise between the U.S. and China, Canada could find itself in the middle of a global standoff, with both sides demanding loyalty. For now, Canada is trying to stay flexible, working with both sides and keeping options open. But if current trends continue, that space to maneuver may shrink. Trade decisions are turning into political signals, and the cost of neutrality is rising. While Canada and China quietly deepened their energy ties, Washington was focused on pressure. The U.S. tried to force allies into tougher trade stances by using tariffs, but it didn't offer clear alternatives. Instead of pulling partners closer, it pushed them to look elsewhere. The 10% tariff on Canadian oil, meant to show strength, ended up backfiring. It gave China the perfect opening to step in with long-term deals, investment offers, and a softer approach. Canada didn't plan to switch sides, but when faced with pressure from one side and partnership from the other, the choice became clear. What Washington underestimated was how fast China could move and how ready countries were for stability. In focusing on confrontation, the U.S. missed the real story. Global trade is shifting, not because of force, but because of better options. This energy shift is just the beginning. China is now pushing to settle oil contracts with Canada in yuan, not dollars. That would move both countries away from U.S.-controlled financial systems, an even deeper break from old trade rules. At the same time, American companies are continuing to lose ground. In 2025, U.S. exports to China dropped nearly 27%, while imports from Canada jumped 44%, according to China's Ministry of Commerce. Energy, agriculture, tech, all are being reshaped by this new trade order. The next front isn't just about goods, it's about who controls the flow of capital, the currency of contracts, and the future of global trade platforms. The U.S. is still a major power, but if these trends continue, it may find itself locked out of the very system it once led. Canada's $320 billion energy deal with China isn't just about oil. It's a turning point in global alliances. Subscribe now for more sharp breakdowns on global power shifts, trade wars, and the stories shaping tomorrow's headlines.